If you are over 60 years old, please listen very carefully to what I'm about to say. This message is not for young investors chasing fast growth. It is not for people who can afford to lose half their portfolio and wait a decade to recover. This is for people who are retired or approaching retirement, people who depend on their savings for income, people who no longer have working years ahead of them to fix major financial mistakes. At this stage of life, the rules are different. Many investors are given advice that sounds reasonable in theory, but is dangerous in practice. They are told to stay aggressive, to remain heavily invested in stocks, and to ignore volatility because markets always recover. That advice may work for someone in their 30s or 40s. It often fails people in their 60s, 70s, and beyond. I've spent decades observing markets, studying investor behavior, and watching how retirement plans succeed or collapse in the real world. I've seen firsthand how inappropriate advice can destroy not only finances, but peace of mind, relationships, and health. Let me explain why. When you are over 60, time becomes your most limited asset. You cannot afford long recovery periods after major market declines. You cannot replace losses with future earnings, and you are withdrawing from your portfolio, not adding to it. This creates a risk many people underestimate: sequence of returns risk. If markets fall early in retirement while withdrawals continue, the damage can be permanent, even if markets eventually recover. Charts and historical averages don't account for the emotional and psychological reality of watching your life savings decline while bills still need to be paid. I've seen retirees panic, sell at the worst possible moment, and never fully recover. Not because they were irresponsible, but because the strategy they were following was wrong for their age and situation. The first and most important truth for people over 60 is this: capital preservation matters more than capital appreciation. Growing wealth is nice, protecting wealth is essential. If you already have enough money to support your lifestyle, your priority should not be maximizing returns. It should be minimizing the risk of irreversible loss. A simple way to determine whether you have enough is this: take your annual spending needs and multiply by 25. If your portfolio exceeds that number, you are likely financially secure under conservative withdrawal assumptions. At that point, taking unnecessary risk can do more harm than good. For people in this position, a balanced, income-focused allocation may look something like this: a significant portion in short-term government-backed instruments and high-quality money market funds for liquidity and stability. A portion in established, dividend-paying companies with long histories of reliable cash flow. A portion in investment-grade bonds with intermediate maturities. A smaller allocation to inflation-protected securities to preserve purchasing power. The goal of this structure is not excitement, it is durability. This type of portfolio is designed to generate income, reduce volatility, protect against inflation, and, most importantly, allow you to sleep at night. Liquidity plays a larger role in retirement than most advisors admit. Having accessible, low-risk assets means you are not forced to sell investments during market downturns to cover expenses or emergencies. Liquidity buys flexibility. Flexibility reduces panic. Equities still matter, but the focus shifts. Instead of speculative growth, the emphasis is on businesses that generate consistent cash, operate in essential industries, and have demonstrated resilience across economic cycles. Dividend growth, not dividend chasing, is the objective. High yields signal high risk. Sustainable income comes from quality, not desperation. Bonds serve a stabilizing role, providing predictable income and reducing portfolio volatility. Keeping maturities intermediate rather than long-term helps manage interest rate risk and maintains reinvestment flexibility. Inflation protection cannot be ignored. Over a long retirement, even modest inflation can significantly erode purchasing power. Assets that adjust with inflation help ensure today's income still matters decades from now. Together, these elements form a system designed for endurance, not headlines. Withdrawal strategy is just as important as asset allocation. Rigid rules fail in real life. A flexible approach that adjusts spending based on market conditions dramatically improves the chances that your money lasts as long as you do. In strong years, withdrawals can increase modestly. In weak years, spending should tighten temporarily. This flexibility protects from permanent damage during downturns and reduces emotional stress. Another critical reality for retirees is healthcare. Medical costs often rise faster than general inflation and can overwhelm even well-planned retirements. Insurance choices, supplemental coverage, and realistic budgeting are essential. Long-term care planning deserves serious consideration, not avoidance. Health itself is also a financial asset. Staying physically active, mentally engaged, and socially connected can reduce medical costs and improve quality of life. Retirement planning is not only about money, it's about sustainability. Estate planning becomes increasingly important as well. Clear documentation, updated beneficiaries, healthcare directives, and trusted decision-makers prevent chaos during already difficult times. These steps protect not just assets, but family relationships. Social Security decisions carry long-term consequences. Claiming too early can permanently reduce income, while delaying, when health and circumstances allow, can significantly increase lifetime benefits, especially for surviving spouses. These decisions should be made deliberately, not emotionally. One of the hardest challenges retirees face is family financial pressure. Helping loved ones is natural, but it must never come at the expense of your own security. Clear boundaries protect everyone involved. Many retirees make the same costly mistakes: chasing yield instead of safety, staying too aggressive for their age, ignoring inflation entirely, overcomplicating portfolios, trusting products with high fees and opaque structures. Simplicity is strength. Transparent, understandable strategies reduce errors and stress. If you are over 60, you are in the final phase of your financial journey. This is not the time for bold bets or unnecessary risks. It is the time for discipline, protection, and clarity. The objective is not to win the game. You've already played it. The objective now is to protect the outcome. Financial security in retirement does not come from prediction or bravado. It comes from thoughtful structure, realistic expectations, and respect for risk. Protect what you've built, reduce stress, preserve dignity, and allow your money to quietly support the life you worked decades to create.